Are you prepared to break free from the conventional notions of luxury and wealth? Unlock the secrets to managing and growing family wealth while preserving legacy. Welcome to Beyond Wealth.
Aaron, welcome to the show.
Thanks for having me, Jonathan. I appreciate it.
Awesome. So I like to start with a little rundown here. So can you give me your company, your role, your team size, and how long you've been doing it?
Yeah, so my company is now Okeanos Venture Management. This all came from a small investment partnership that we started here in Northern Virginia back in 2016 that was formerly called Riverbend Capital. Back then, it was my partner and I, Mark Dumas, who were building up a small angel group. This was really a passion project, a nights and weekends side hustle, while we had our other careers. We built that up from a small local group to a large national membership-based venture firm. What we recognized back in 2022 is that that little investment partnership that we had started had grown into a group with over 100 members and over 100 investments closed. And that little animal had grown into more of a monster that required a lot more administrative work, full-time work, in real leadership and management. So we rebranded and relaunched Riverbend Capital in October of 2023 as Okeanos Venture Management. And today we've more than doubled the size of our membership over the course of the year and about tripled the amount of invested capital throughout this year.
No, that's
Our
amazing.
team size, we currently have about 8 folks, some full-time, some part-time, and we have a budget plan for this coming year where we're going to be building out more internal resources in terms of financial, technology, and operational staff so we can continue scaling nationwide.
Yeah, and what's your role with the organization?
So I'm a co-founder and managing partner. So I'm effectively the CEO role. This is my full-time job. This is what I work on morning, day, and night, 7 days a week. While I was in the commercial real estate business for all of those years with Riverbend Capital, it became pretty apparent to me and my old partners at that old firm that this is really where my passion lies. So I've kind of fallen backwards into the role that's really perfect for me and what excites me about entrepreneurship, venture capital, what I like to say, rolling the dice and taking risk and trying to beat the markets with some diversified risk across private asset classes. So it's been an exciting journey so far, and we're really just getting started. We like to say we're a 7-year-old startup that has a really bright future ahead of us.
That's awesome. And speaking to that passion, our listeners would love to get a little bit more on that background and maybe any inspirational moments that have led to where you are today.
Yeah, it's actually interesting. Back in my early commercial real estate days, I was a tenant rep, which means I was cold calling and networking and trying to get hired by growing companies in the DC region to represent them with their office space transactions. And I took a little alternative approach to that business development strategy very early in my career, where I was not focusing on companies that had a lease expiring. I focused on companies that were hiring. And that naturally led me to representing primarily technology companies that were in growth phases. So early in my career, I was doing a lot of very small startup transactions. A number of those companies grew to become very significant publicly traded technology companies. And it was a few of those founders that I was working with on the real estate side that started encouraging me to get into angel investing. Now, I did that more than 10 years ago. And anybody that has experience in angel investing knows that those are very high risk, very illiquid, long-term investments that most often do not succeed. So my first number of angel investments that I made were primarily friend and family investments, some up in Boston where I grew up, some down here in the DC area. And that was really what got me very interested in the venture capital asset class. I had then become aligned with Next Gen Venture Partners in DC. That was a formalized, operationalized angel group that went on to raise a series of funds that I'm also an LP in. And also Gangels up in New York that has very unique access to later stage top tier led rounds. And it was really through those 3 experiences that enabled us to start to build out Riverbend Capital into the Okeanos Venture Management business that it is today.
Yeah, and I think that goes along with one of the things that we really like to stress here on Beyond Wealth is that, we all work to live versus living to work. And it sounds like you've found a nice niche for yourself and, must make for a personally and professionally rewarding experience for you.
It is. I could say that work never feels like work these days, but work certainly takes a lot of time. And whether that's a Saturday morning or a Sunday evening or just a normal working hour, There's a lot of work to be done to build the business to scale.
Yeah, that's awesome, Aaron. And I think I really want to dive into your expertise and start to pull some of the strategies out that you guys provide. I'm really interested in kind of your approach to building a diversified portfolio, both for individual clients, your members, and also some of the family offices you work with. And I'd love to understand some of the factors that are kind of most critical in your decision making process as you're diversifying for your members.
Yeah, absolutely. And that's a great question because broad diversification has always been our core thesis, which is very unique in the venture capital and private equity space. Where generally the venture capital and the private equity GPs are looking to raise predominantly institutional capital with a very strong thesis and focus on either a sector or a stage. We took a different approach, which was really focusing on the most broad deal flow across stage, sector, and geography to provide all of our members with access to a variety of opportunities where they can participate where they would like to, and not where they would not. So I think it's important to understand that the Okeanos venture management model is not a traditional venture fund model. We are built on membership and a community of individual members that get to make their own decisions in where they would like to invest. And in doing so, it's our responsibility as the management team to ensure that we're providing a broadly diverse set of opportunities for those members to participate in. Now, those aren't just venture. While we do quite a bit of early stage through pre-IPO venture investments, we also invest in private equity. We've done private equity roll-up transactions. We invest in real estate development projects that provide more what I'll call lower risk, asset-backed, cash yielding opportunities.
Mm-hmm.
We've even ventured outside of traditional venture into alcohol beverage and cannabis in states where legal. So broad diversification is really at the core of what makes us unique and what makes us attractive to our members that will generally have their wealth being managed by other financial advisors, multifamily offices, or family offices. And what they come to us for is that access into the more exciting world of individual private investments. And whether that's a pre-IPO investment in a company like Cerebras or an early stage investment in a company like Estate Space, we like to provide those opportunities really across the spectrum so that they can pick and choose what makes sense for them in their own personal financial position.
Yeah, and when you mentioned risk there, right? And so there's a balance between the risk management that you have while still trying to achieve growth across that diversification. And especially like right now in a softer market where there's a huge push for AI investment. I would imagine that you guys are also looking to diversify even within that space, and also applying strategy around maybe in a softer market, maybe a little bit more early stage and a little bit more later stage. And so I'm really interested in kind of how are you balancing that risk and diversified growth, especially in a market like today?
Yeah, the past couple of years have been really tough across the public markets, private markets, in particular venture capital. We took a position about a year and a half ago that the valuations and structure in term sheets on later stage investments had become incredibly attractive, where we felt that you could get the upside of an earlier stage investment with more downside protection of the later stage investment, higher liquidation preferences, warrants, PIK interest. So that's why our focus really shifted a little bit upstream, more towards the Series C's and D's and pre-IPO investments.
Mm-hmm.
And we think that those have played out really well. The valuation multiples on the later stage investments have come down dramatically. And we believe that over the next 1 to 2 years, as we're in more of a Fed rate declining environment, we'll start to see the risk off shift on, and those valuation multiples start to increase and the IPO window start to open. So we'll be rewarded for the risk taken in 2022, 2023, and 2024 as we see a rebound in the broader markets from a valuation perspective. We've actually shifted a little bit further away from the early stage, which goes against a lot of the trends in the venture industry. You've seen a dramatic decline in later stage funding and a somewhat relative, consistency in the amount of early stage investment, and in particular in the valuation multiples on the earlier stages. Our members, myself included, were not ultra high risk ultra diversified, early stage angel investors. We don't necessarily look to make 30 investments and cross our fingers and hope that 2 or 3 of them are grand slam home runs that take care of all the other losers. So we do look at every opportunity through the lens of the risk and the reward. We diversify heavily across 25 or 30 investments per year. But from a risk tolerance perspective, we're really looking at finding those opportunities that have great upside potential with more limited downside potential. And we find those opportunities in the Series C to pre-IPO asset classes right now.
That's awesome, and I think that's valuable, and there's some things in there I want to talk about. You guys, I've had the pleasure of knowing you now for quite a bit of time, and you guys are now a part of our cap table, and we're excited to be partnered with you guys. I've also heard you talk about other investments that your firm has made, and I'm really interested in kind of your approach to meeting founders, getting to know them. As you mentioned, 4 or 5 years ago, it was just invest in a lot of things and hope one of them hits. And now it feels like a lot of our conversations have been around capital efficiency and structure of the business, and how we're actually going to achieve that growth. And I'm interested in some of the tactics and strategies that you have when you're meeting a new firm, a new opportunity comes, and your relationship with those founders and some of the investments that Okeanos has made.
Yeah, excellent question. This is a relationship business on both sides, right? With the membership and the investors that we're working on behalf of, and also the venture firms and the private equity firms that we partner with to get access into the much larger, more exciting, top tier led types of investments that generally a relatively small firm like ours that might only write a $2 or $3 million investment can't get access to. But in terms of process, back in the early days of Riverbend Capital, when this was a pro bono operation where nobody on management was getting compensated, there was no salary payments, there was no carried interest, there was no upside. It was really challenging for us to put a lot of those processes into place because they require resources, financial resources, personnel, more technology, more operational management. When we made the switch over to from Riverbend Capital to Okeanos Venture Management, we were able to structure in those processes and those resources. So now when we're looking at new opportunities, and in any given month, our team might review 25 to 50 new opportunities across seed through pre-IPO and other alternative investments. We now have weekly and monthly processes for how we screen all of the opportunities that we have, how we start doing diligence on those that we believe rise to the top, and then how we prepare and present those opportunities to all of our members. These include in-depth investment summary material creation. We host founder and co-founder Q&As with our group that we then professionally prepare and share out with all of our membership. And we provide a number of other ways where our members can ask questions in their own personal diligence processes. So we're not just making high risk investments and kind of throwing it against the wall and seeing what sticks, but we have a more methodical, detailed process that enables us to make more educated decisions. And then the last point there is that we're really leveraging wisdom of the crowd across our 175 and growing members. But when we're looking at a biotech investment, we're leveraging the expertise from within our group with our medical doctors and health insurance experts to really draw on their expertise to help the broader group benefit from that experience that they have to help us make a better decision. Sometimes the better decision is avoiding a mistake, and other times the better decision is investing a little bit more. And we believe that secret sauce of ours, which is leveraging that wisdom of the crowd and those subject matter experts, helps us make better decisions across the board.
Yeah, and I think in one of our conversations, you'd mentioned that it felt a lot better when you had 10 to 20 people that were all excited about investment versus just yourself. And so it sounds like you've taken that tradition and brought that along to this venture.
Yeah, one of the kind of the founding thesis of Riverbend Capital was, here were 7 or 8 of us that were actively investing individually. And we decided that if we wanted to make a personal investment in a startup, but we couldn't convince 3 or 4 of our other partners to participate, then it probably was not a wise investment to make. So we apply that thesis today. just in much larger numbers with a much broader base of members that come from very diverse backgrounds across the country.
Awesome. And so, I think now I really want to focus on kind of the family office side of the business. I've spent the majority of the last 15 years in that space, and I've watched them, balance traditional investment with alternative assets. And I'm just curious, kind of, what role do you see alternative investments playing in the diversification of some of your family office members?
Yeah. So we've had members of Riverbend Capital and Okeanos for many years that have their own single or multifamily office operation. We have not historically worked for the family office. We've worked for the principal that makes their own decisions on behalf of that family office. Throughout the course of this year, we have started relationship building with a number of single and multifamily offices around the country.
Yeah.
And what I've found to be very interesting is I've heard similar feedback from them with regards to the venture and private equity allocations within their portfolios and really what excites them and what they're looking for. Unfortunately for our model, being a more of a syndicate membership model where there's flexibility and optionality with which investments to participate in, what we're hearing from these single and multifamily offices is that they're somewhat bored with the traditional venture fund options, and they're getting much more excited about participating on a deal by deal basis. Um, those that we're speaking with aren't necessarily focused on the earlier stage. I would think that if they are focused on early stage, they're in a number of different funds and they're broadly diversified across fund managers. What they seem to be more excited about now is what we have been focused on over the past few years, which is unique access into very large, very top tier led, strategic led later stage rounds, where we have the ability to put a relatively small investment into something significantly larger. One example of that is the Figure AI investment we made earlier this year that had, I think it was $100 million from Jeff Bezos and Microsoft and a long list of top tier VCs and strategic investors. And we were able to find $1.5 million out of that round for our members. And that was a big win for us. Not an enormous investment, but relative to the investment that was going into the business and the potential of the business, a really nice place to be for a group of individuals that otherwise would never have access to that level of opportunity. And I think that that's what's exciting for the family offices as well.
Yeah, and I've also seen a big shift, and it was a lot of fund to fund investment, and now we're starting to see a lot of direct investments out of funds that may have been just purely fund to fund, and their thesis has started to shift over the last 12 to maybe 24 months now.
Yeah, I think the family office sector is one of the earlier, larger pools of capital to come back into the risk on environment. I think it's going to take a lot longer for the institutional capital to start flowing back to the venture funds. But we do see the family office and the multifamily office community getting much more active in the venture side on a direct basis today than they did 5 years ago. And that's really positive and promising for the kind of the tech startup ecosystem across the board, because they're effectively filling a gap that the institutional capital has really left open for the past few years, as they've really focused more towards yield and risk off.
Yeah, and one of the things I know you guys have done to help diversify some of your more passive members is you've actually started your own vintage fund at Okeanos.
Yeah, the vintage fund is unique. We actually were asked by some of our members a few years ago who are, full-time CEOs of publicly traded companies to create a more passive, diversified opportunity for them. So what we created was a vintage fund that very simply participates in most of the investments that we make throughout the course of 1 year, so that our members have the ability to be a little bit more passive, to not miss out on the next Kava pre-IPO investment because they were on vacation, or they were busy with work life. And so far, that's been really successful. I think what's unique about that fund is that we are not a fund first strategy, which is what the majority of venture capital firms are in the market that might have a syndicate model and a fund model.
Yeah, no, those are really great points. And, I think, now that we've kind of talked about how you're diversifying, how you're managing risk, I know that you guys have a CFO on your team, and I know that that's a very important role in an organization like yours, especially in the beginning and as they're trying to grow. What metrics kind of and indicators do you guys use to evaluate the success of your portfolio? And, how do you guys adjust strategy based on that performance?
Yeah, so we don't analyze the broader portfolio like a traditional VC fund would, because every
Okay.
investment is a unique set of investors and participants. So we analyze new opportunities based on what we think a kind of a base case return profile might look like, what a more aggressive outcome might look like, and what a downside scenario is. I'd say one of the biggest changes that's happened over the past year since Jason Parikh, our CFO, has come on board is that we do a lot more financial diligence and modeling before we make an investment. Back in the Riverbend Capital days, we didn't have the time or the resources to do that. So now when we're looking at a Series C investment, we're actually modeling out what the company's provided financial projections look like. We're then baking in what subsequent rounds of funding may look like that enable that growth to be possible, what the dilution from those rounds might look like, and then a variety of exit scenarios on what an IPO or an acquisition may be, and providing more detailed financial analysis around what that return profile might look like. We're not in a box where we can only participate in a certain stage and sector with a certain return profile with a specific ownership percentage of the business. So we have a lot of flexibility in what we can invest in. What we focus on doing is providing very detailed and in-depth financial analysis on the opportunity so that we have a general understanding of that risk and reward potential for the company that helps us make those better decisions. That also comes into play when we're working on a real estate development deal. Different risk reward profile. We're modeling in the cash yield from the distributions, what a potential recap scenario might look like in 5 years, what a sale scenario might look like, but really trying to build in a better foundation of financial analysis and modeling to enable all of us to make those better decisions with the risk and the reward in mind.
Yeah, that's interesting, and I do know though from an investment to investment, you guys are kind of managing along, and you're staying with that investment and providing updates along the way as that investment grows and either nears a distribution or exit. As far as like kind of your member expectation, right? We talk a lot on this show about values and, legacy and preservation of those values. And so it feels like you guys have a really good sense of who you are, who your people are, and making sure that as you're bringing in new members, those values align. And so, ensuring that, you have alignment with those goals and values for all of your members and family offices. Is there anything that you're doing kind of, with the group outside of deal flows to make sure that both that you're they're comfortable with the goals and the strategies that you guys have? I'm curious some of the kind of we talk about relationships as well, and I'm just really curious kind of the relationship management strategy you guys have is a very unique organization.
Yeah, so we're really built on human connectivity and community. We've seen other angel groups kind of evolve and grow into more of a platform that loses that human connectivity and those personal relationships. Every time we're making an investment, I'm either on the phone or text messaging or emailing with 30 to 50, sometimes even more of our members that would like to get my personal opinion, and would like to talk through the diligence and the expectations. So the personal the personal connectivity is a really significant kind of backbone of what makes us in our community really special. It's become a little bit more challenging this year as we've really grown with new members outside of the DC region. Over the past 3 or 4 years, we've had quite a few folks up in the Boston area and out west in San Francisco. But this year we've added 90 new members this year, predominantly outside of the DC region. And those members don't get the benefit of attending our monthly events here in Virginia. They don't get the benefit of attending my super fun lawn parties that we throw here in Great Falls once or twice a year. So what we're trying to work on now are more national events that can bring all of our members from around the country together so that they can make new friends and feel like they're more a part of this community from a human perspective. And we think that that's really important as we continue growing, that we provide more opportunities for folks to get to know each other and help each other, because that's another big part of this is, our members, many of them are friends before joining, but many of them become very good friends with other members after joining. and they help each other with family. They help each other with business. They're supportive. And we're always looking for ways to bring that broadening membership base closer together. Because at the end of the day, what we are is really a community of individuals that like to win together, but also look to help each other in various ways. And these folks also are very helpful to all of our portfolio companies. So we've now closed 130 investments over 8 years. We generally don't look to take board seats for control and influence, but we're always looking to find ways to leverage our membership experience, network, connections, and support to help those founders accomplish their goals and their dream in a bigger way. And that's something that we were just doing yesterday with one of our portfolio companies that has an issue out in Denver. So we have some members in Denver that are working to help find ways to support those challenges in Denver. So we like to think that we're a value add type of investor, even though we're not structured like a VC firm that would take that active board seat and deliver resources that would be more typical of a VC firm taking that position in a startup.
Yeah, and as a founder, I really love and appreciate that. My philosophy's always been, if I have an opportunity and I can help somebody, then great. But if I'm not the right person or the right fit, I don't like theses that kind of force things to happen just because that's how it's been written. So,
Yeah.
as a founder, if I need help and I can reach out to somebody like yourself and your group and have those types of resources, it's just something that is actually one of the attributes that I'm looking for when I'm bringing on new shareholders into the business and
Yeah.
growing our network.
And you as a founder also need the support, but you don't necessarily need to give up any control, and you don't want more bureaucracy in the boardroom that takes away from your nimbleness and your agility and your ability to make big important decisions as you need to make them. So we really try to avoid playing that power control role, but still trying to provide as much value and support and guidance as we possibly can to help that founder succeed.
That's awesome. And so for our listeners, we're talking with Aaron Berkey of Okeanos. He is the managing member and co-founder. He's been sharing a lot of wonderful strategies on diversification and risk management and really focusing on aligning its goals and values with his group to be able to grow into a larger national organization that at some point in the future, I can see probably a summit and potentially chapter groups within this model. So, I want to kind of flip it now and go kind of personally to you and, focus on yourself for a moment and how you kind of go beyond wealth yourself as an individual to really try to find a good work-life balance. Again, we talked about, working to live versus living to work. And so just curious some of the things that you do personally to just, stay, mentally, emotionally, physically fit.
Yeah, so there are really two, maybe three very important events that happen Monday through Friday in my household that I always try to be present for. Number one, I always want to take my kids to the bus stop. Number two, I always want to be home for dinner. And number three, I always want to put my kids to bed. And with that, there's a lot of time that gets taken out of at a typical workday. So some strategies that I take, I try to get up early. I try to get my workout done before my kids wake up. That's always box number one. If I can accomplish that, usually the rest of my day is very productive and enjoyable and stress-free. Traveling is something that has to happen, and often you need to travel to take advantage of an opportunity or develop a relationship or attend an event. I always try to leave early and get home the next day, even if that's going to LA for an event that I have at night. It's always my goal to get there and back as quickly as I can so that I'm there for the family and they don't see me as, dad's away for another 3 or 4 days and, not being home for the family. So family first is really important to me. My wife is also an entrepreneur. She runs her own small business. So she also has some of those challenges that come with putting out urgent fires at times when it might conflict with the family event. But always being there with the family and with the kids is really important to me. And with that comes very disciplined time management. When things need to get done and you don't want to jeopardize the family commitments of dinner time and bedtime, sometimes that means you're up late at night. Sometimes it means you're taking a couple hours out of a Saturday where you can. But you just find ways to make that family life, work-life balance work for everybody and still be as productive as possible without falling into the trap of workaholic that is not good for anybody.
Yeah, no, that's wonderful, and that's again, legacy preservation and family first is really that is luxury in our worlds today, Aaron. So that's wonderful insights. Thank you. So, can you just share with our listeners where they can find you online?
Yeah, LinkedIn is best. I actually treat LinkedIn as my go-to social media outlet, so I'm not very active on Facebook and Instagram, although I do post from time to time. We're currently working on a new website, so our Okeanos website is going to be fully updated with all new functionality and blog posting and the like. Um, and that actually coincides with a new technology platform that we're in the process of building out for all of our members as well. So there's going to be a lot of social blogging, podcasting tie-ins to the new platform that are going to benefit our members as well. So I'd say if you want to hear from me and see what I'm up to, LinkedIn is the best way to keep track of my whereabouts.
Awesome. Well, Aaron, thank you for joining us today. I just want to thank all of our listeners to tuning into another episode of Beyond Wealth. I've really enjoyed this conversation, the insights. Thanks a lot, Aaron. I appreciate it.
Thanks for listening. If you found this conversation valuable, please leave a review on your favorite podcast platform or watch the conversion unfold on our YouTube channel @EstateSpace. We will see you next time on Beyond Wealth.